Welcome to the VectorVest special presentation, this week titled 7 Ways to Whip Inflation with Less Risk. My name is Todd Shaffer, Manager of Research. I'll be your presenter this evening. Inflation is at its worst in 40 years, and interest rates are rising. The way to beat them is to outpace them. That doesn't mean we all need to become aggressive traders. We can win without taking on excessive risk. Of course, if inflation is the worst it's been in 40 years, by definition, it was worse 40 years ago. Whenever I talk about whipping inflation, I always think about Jerry Ford's presidential campaign, Win with Jerry Ford. WIN was an acronym for Whip Inflation Now. His proposed solutions included voluntary austerity measures instead of Nixon's price controls. He lost, Carter won, but the malaise continued until the Reagan administration finally cracked the code. So we've been here before. So first of all, this too shall pass. But also use Dr. DeLito's 7th secret to success. Be an optimist. VectorVest can help us navigate this storm, and as he wrote, my belief is that when you deal with facts, you can face the future with confidence. If you like that bit of wisdom, there's more to be found in his essays and in his book, Stock Strategies and Common Sense, which we affectionately call the Little Green Book. You can get your copy right now if you click on the download link in VectorVest. So let's open the program. I'll show you where that is. From the home page, click on the Welcome tab, and here's the download for the Little Green Book. Click on it, and after you do the download, you should have something that looks like this, Stock Strategies and Common Sense, the 3rd edition. We originally published back in 1995. And of course, if you're a student of VectorVest, we just did our 3rd edition update this past January. So let me zoom back out and let's go looking for some more bits of wisdom. And I think you'll find some in the very first chapter, the 6 greatest stock market myths. And in particular, I want to drill in on myth number 4 to get us started. It references inflation, our topic of this evening. And myth number 4 is that stocks are a hedge against inflation. For many years, stockbrokers and mutual fund salesmen have been saying that stocks are a hedge against inflation. Well, stocks are, and they're not. It depends on how you look at it. A true inflation hedge is one that increases in price with higher inflation, like a house or gold or collectibles. The fact, however, is that inflation is the stock market's #1 enemy. When inflation goes up, interest rates go up, and 2 things happen. The first thing is that investors say, golly, I can make all that money on high interest rate bonds, at least we used to, so why should I invest in stocks? So they take their money out of the stock market and stock prices go down. The second thing is that the cost of doing business goes up, so corporate earnings go down, stock prices go down, and a bear market is born. So why in the world would anybody say that stocks are a hedge against inflation? It is because stock prices can go up faster than inflation. All you need to do is invest in stocks which have steady earnings growth rates higher than the sum of inflation and long-term interest rates. When you do that, the prices of your stocks will go up faster than inflation. They'll be whipping inflation by staying ahead of it. So earnings growth is the key to beating inflation. But what about the risk associated by chasing high-flying stocks? Well, let's scroll up the page a little bit because Dr. DeLito handles that consideration in his 2nd myth. You must assume high risk to make good money in the stock market. A woman recently said to me, I'm just scared to death of stocks. I cannot afford to lose my hard-earned money. The perception of high risk in stock investing is not totally without merit. I just heard on CNBC that the average investor is losing money. Why is that? They're being sucked in by the hype and fluff that meme stocks, SPACs, cryptocurrencies, Bitcoin, and whatever will make you rich. Just the opposite is true. You do not have to assume high risk to make money in the stock market. The way to make money in the market is to buy stocks that have consistent and predictable earnings growth. Earnings growth is the engine that pushes stock prices higher and higher. Here's how to make good money in stocks with low risk. And I know what you're thinking. Finally, put some meat on the bone, something I can use. So, number 1, buy stocks with consistent, predictable earnings growth. Number 2, buy stocks with double-digit earnings growth rates. Number 3, do not put more than 10% of your money into a single stock. Number 4, buy between 10 and 20 stocks. Number 5, do not own more than 2 stocks in the same industry. Number 6, do not plunge into the market, spread your investments over time. And number 7, use stop-sell orders to limit risk. Since a picture is worth 1,000 words, I'll create a study to illustrate these points, and I'll do it in the Backtester. Let's move back into the program. And let's move to the Backtester tab. And we'll get started by clicking Backtest an Idea. So the Backtester takes our historical database and runs it through time, and with the auto timer feature, will automatically incorporate search results with market timing signals, stop losses, etc. And so you can get an approximation of what might have happened historically for any given trading approach. And it begins by giving our backtest a name. So I'm just going to call this one 7 Ways. And we'll say this is our baseline study. Now let's set up the account settings. If I click Edit Account Settings, we'll have a $100,000 portfolio. I'm going to change my commission to $1. Not that I pay commissions anymore, many of us don't, but this will give me a trade count by just assessing $1 to each trade. And then we'll leave the defaults executing buys and sells at the next day's open in daily mode. So click OK. So to build a custom trading system, the first thing it wants to know is, well, what market timing signal system do you want to use? So let's use Green Light Buyer. It'll help me illustrate some of these points. I can click Next or come down to Automation Rules, and the first thing it wants to know is, well, okay, in automation mode, which search would you like to use from the database? Now, of course, I can also build my own, but I have one in mind that I think will be perfect for what we're doing here. Jumping over to the Unisearch tab, these are the searches that the Backtester can use to conduct the backtest. And in the Prudent folder is one of my favorite searches, ruler stocks. Let's take a look at ruler stocks and why it's so appropriate for this demonstration. First of all, remember our list. We want to buy stocks that have consistent, predictable earnings growth. That's high RS, right? Relative safety is the thing that looks for that consistency and predictability of financial performance. And so we have a search parameter that requires the minimum value for the search to return that stock. It has to have a minimum value for RS of 1.4 or higher. The second parameter is that it had to have a growth rate in double digits. Well, here we're looking for growth rates in excess of 14%. You can make that value be anything that you designate, but again, Dr. Giolito suggested in his essay that at a minimum you want to have a growth rate that exceeds the hurdle rate, the combined rates of interest and inflation. Next, we have a set of 5 parameters you'll see in many of our searches that make them quote-unquote derby ready, but minimum price and volume requirements. And the power of any search is the sort. We're going to sort the list. So at the top of the list are the stocks that have the strongest combination of relative safety and growth rate. Let's run the search. I'll minimize the fields. Notice that we're sorted by RS times growth rate. That was our custom field, and so we're sorted descending. But let's look at the stocks it's finding. Let's look at some of their VectorVest analysis. Look at these RV scores. Look at these RS scores, right? In excess of 1.4, just as we asked. And earnings growth rates well into double digits. So beyond the number, the hard number of growth rate, we were also looking for that consistency and predictability of that financial performance. So let's take a look at the graph. And here I'm looking at weekly candlesticks over a 5-year time frame. So this is a longer look. And what I just want you to look for, we call it VectorVest Simple. I'm just looking for this bottom left to upper right price architecture or price trend driven by a similar earnings per share trend. So earnings for Tesla, bottom left to upper right, smoother the better for both earnings and price. That's what we want to see. Even with that consistent financial performance, however, that's not to say that Tesla doesn't suffer just like any other stock in market corrections. Which is why, of course, we advocate that we buy rising stocks in rising markets. But if we just look at these top RS stocks on today's search result, just broadly speaking, what beautiful graph patterns. And of course, some are better than others, which is why we advocate that we always look at the graph. But in terms of defining a universe of great stocks, I hope you can see why I like ruler stocks. So let's use this search for our demonstration. We'll come into our automation rules. I'll scroll down to the searches prudent folder, and let's find ruler stocks. To set our baseline, I'm not going to set any stop criteria. Let's make sure we're trading 10 positions. We'll not limit the number of positions opened in the day. When entering this situation, we'll choose don't close any open position, which means if we have a green light that then changes to yellow and changes back to green, we're not going to close the portfolio every time we get a fresh green light. We'll invest the average of the portfolio value across those 10 positions, trading odd lots. Let's not repurchase stocks that we currently own, and we'll leave the default maximum percent of stocks average volume at 10%. Click Next when the automation rules do change to down. We'll move to cash. Since we don't have any stops in place, that'll take us out of downtrending markets. Let's click Finish. And let's change our date time to something more substantial than 1 year. How about 10? So we'll see how this performs over the long term, which means I need to go back to 2012. March, and we're working on the 17th here, so let's go back to the 16th, which was a Friday, as our start time. And then click Finish and Run. So the backtest starts in the automation pane. You can see that we're executing the trades. So as that goes on, we can see the equity curve developing for the portfolio. So I'm going to pause the video here so that we can let this backtest run because it will take several minutes. So stand by through the miracle of time lapse. I'll be right back. So with our baseline test complete, let's take a look at the results. On our performance line, we can see that the backtest resulted in a 51.9% winning trade percentage, so 51% winners, an overall gain of 9.04% over 10 years. That averages to 9% per year. We made 830 trades over 10 years, so that's 83 trades per year, or about 1.59 per week. So that's not too actively traded. And lastly, our maximum drawdown, 33.2%. So the biggest pullback in the equity line performance of the portfolio pulled back 33.2%. So that's not the average, that's the max. But you can see if we take a look at the equity curve, really kind of moved sideways through this time frame through 2020. Here are those big drawdowns on the market corrections of 2016. Late 2018, here's COVID in 2020, and the current correction that we're in. And those market corrections keep taking back our hard-won profits. So to improve those drawdowns and improve the performance of the portfolio overall, let's try limiting those drawdowns using a stop loss. So let's strike a copy, and now I'll go into customize our trading system. And in the automation rules up, let's add now our stop criteria, and I'll choose rec equals sell. And yes, you can test many combinations of stop criteria that you like. That's one of the benefits of the backtester. But with that one simple change, I also want to change my automation rules down from going to cash to let's just hold through those down signals. And let's update our name, and we'll call this rec equals sell. And let's click finish and run. Let's look at the numbers. So our hit rate actually fell, but our overall gain increased substantially. So we're actually making more money by capturing our gains on average, because you can see we only had a slight improvement in our maximum drawdown. We also traded about half as much as we did in the prior example. So now we're down to less than 1.84 trades per week. Looking at the equity curve, we can see that by holding through each confirmed down signal and just relying on our stop price to take us out of the trades, our high RS stocks recovered from those market pullbacks to reach higher highs. Now, I still see those pesky pullbacks, but now I'm in profit, right? So I'm at least making the stair step higher, which is a great sign of an effective trading system. Now, let's do another pass. And for this pass, I want to incorporate the last two items from Dr. DeLito's list. So we'll go back into the automation rules, go back to more settings. Now, instead of just buying 10 positions all at the same time, we're going to diversify risk by spreading out our entries, only taking 2 positions in any single day. Which means when I get a green light, I'll only open a maximum of 2 positions. So it's going to take me at least 5 tranches to get to 10 positions, or 5 green lights to get to 10 positions. So I'm spreading the risk of a pullback, for instance, on a dead cat bounce. I'm spreading that risk over time by deploying my money into the market at a slower rate. The other thing he suggested is that we diversify those investments across industries by trading only a maximum of 2 positions of our 10 in any individual industry. So for instance, once I own 2 stocks that are in the semiconductor industry, I won't buy any more. So let's see how these changes impact our results. Now let's compare our numbers. So our win rate actually improved to 37.5%. Our gain loss improved to 170, which again on an annual average is 17%. And the number of trades actually went down to 394. And our drawdown improved to 25%. We're now getting to the wheelhouse where most people feel comfortable. And just to give me a better reminder, I should have changed the name for our test. So let's go into Edit, and I'm going to call this Rec equals Sell 2x2. Stepping in 2 stocks at a time, 2 per industry. So that updates the name. And there's one last idea I want to demonstrate, and that is position sizing. So remember, Dr. DeLito said trade between 10 and 20 stocks. Well, what's the difference? Well, if we trade 20 stocks and have the same amount of money deployed, then each position is going to be half the size of the 10-stock portfolio. So half the risk should the stock hit its stop loss. Also, with 20 positions, it'll take longer for us to fill out the account. So let's strike another copy. We'll go back into our trading system rules. And under more settings, let's just change this to 20 stocks. Click Finish. And I can add 20 STKS to the name. So once again, let's take a look at the numbers. Our win rate actually improved from 37.5 to 39, almost 40. Our gain, however, fell from 170 down to 159, from 17% down to 15% on an annual average. And our trading activity almost doubled from our previous run when we doubled the number of shares that we were trading. But still, on average, you're at 1.18 trades per week. So not like you're actively trading. and we got our maximum drawdown below 20%. So this demonstrates how these risk management strategies can improve our performance. You're outperforming the market's historical average. Are you happy? I do notice that the biggest drawdowns still occur in 2016, 2018, 2020, and current. Are there other things that we can do? Well, you bet. Dr. DeLito shared many more ideas over the years. In the Successful Investor course that I helped teach with Brian D'Amico, we teach additional techniques from Dr. DeLito that can't be replicated easily here in the Backtester. But they include the following. We'll put them on a slide. Set a stop loss at trade inception, your line in the sand that should the price fall below that level, you'll close the trade automatically. This protects or defines maximum risk in the trade. Lock in gains as soon as possible. Slow your purchases when markets are topping, and tighten your stops in falling markets. If you'd like to learn more about these techniques, we are forming our next live course for the Successful Investor right now. If you'd like more information about the course, just jump back over into the program, go to the training tab, and if you scroll down, there's a link in your program to register for the course or to find out more information about it. Of course, that course registration closes at the time I'm recording this in 4 days, 5 hours. So don't delay. You can see the clock is ticking. Now, coming back to the slides, just to wrap up, I wanted to share with you the comprehensive list of the 7 ways to lower your risk that we demonstrated today. And I provide these for your review. But in closing, when inflation rears its ugly head, there's no need to fear. The way to win is to face it and outpace it. As you've come to expect, VectorVest makes it easy. Thanks for watching.